We open today's deep dive with a macro signal that is rippling across every asset class on the board right now. A senior Goldman Sachs executive stepped forward this morning to affirm that market traders are correctly positioned on Federal Reserve rate hike expectations. And that is not a trivial statement. When one of Wall Street's most influential institutions publicly validates the rate trajectory embedded in Treasury yields, it shifts the conversation from speculation to institutional consensus. The 10-year Treasury yield is sitting at 4.49% this morning, up 0.63% on the session, and Goldman is essentially saying the market has it right. That removes one of the biggest wildcards traders have been pricing around. Here is the core fact. A Goldman Sachs executive publicly stated that traders are correctly positioned on Federal Reserve rate hike bets. This is institutional validation of the pricing currently embedded in the Treasury curve, where the 10-year yield stands at 4.49% and the 5-year yield sits at 4.21%. The 13-week T-bill is yielding 3.62%, a spread structure that reflects a restrictive for longer policy stance with hikes remaining on the table if incoming inflation data demands action. Goldman's statement is significant because it aligns one of the street's most watched macro desks with the CME FedWatch implied probabilities and recent FOMC forward guidance, effectively reducing the probability of a sudden policy reversal catching markets off guard. The deeper significance here is not just about one yield tick. It is about the elimination of a tail risk that has been quietly weighing on positioning across both fixed income and equities. Markets have been wrestling with the possibility that the Fed could pivot unexpectedly, either cutting rates sooner than signaled or pausing hikes on softer data. Goldman's validation essentially closes that ambiguity gap. When a firm with Goldman's research depth says traders have it right, institutional money desks take note and adjust their conviction levels accordingly. The higher-for-longer thesis now has top-tier street confirmation, meaning portfolio managers who had been hedging against a dovish surprise can unwind those hedges, and that repositioning itself moves markets in a meaningful way. Let us walk through the transmission mechanism to specific tickers. Long-term treasuries, the long-duration Treasury ETF, faces continued headwind as elevated yields suppress bond prices. There is no relief rally coming if Goldman is right. The Nasdaq 100, tracking the Nasdaq 100, is down 0.04% and represents the most rate-sensitive equity cluster on the board. Sticky discount rates compress growth stock valuations directly. The S&P 500 at 739.56 holds a modest gain, but that resilience is concentrated in financials, where JP Morgan and Bank of America benefit from higher net interest margins in a sustained elevated rate environment. The Russell 2000 at 291.81 is up 0.48%, but small caps carry heavier floating rate debt burdens, making them vulnerable if hikes materialize. Gold at 4,223.20 and silver tell their own story. Real yield pressure is still supporting precious metals even within a hawkish frame. For traders managing positions around this theme, here are the levels that matter. The 10-year yield at 4.49% is pressing toward 4.50%, a psychologically important resistance level, a clean break above that would accelerate pressure on rate-sensitive growth names under the Nasdaq 100. Support for the 10-year sits near 4.35%. A drop to that level would require either a significant softening in inflation data or a Fed communication reversal, both of which Goldman's comments now make less likely. On the equity side, the S&P 500 support sits near elevated levels on the S&P 500 index, while Nasdaq support is at corresponding levels. Gold is breaking above intermediate levels on a safe haven and real yield compression bid. Watch 4,250 as the next resistance. The next hard catalyst is any fresh CPI or PCE print that either confirms or challenges Goldman's hawkish alignment. The bottom line is clear and actionable. Goldman Sachs has handed the market a confirmation that higher for longer is not a fringe view. It is now the institutional base case. Investors should defensively position in high-quality, low-beta dividend equity and avoid reaching for duration in long bonds until yields show a credible pullback. Maintain gold hedges, as the 4,223.20 level, with a 3.25% gain today, suggests the safe haven and policy uncertainty trade remains very much alive even within a hawkish environment. Financials remain the equity sector most structurally rewarded in this rate regime. That is the full picture on Goldman's Fed validation and what it means for your portfolio today. Coming up next, a story moving global commodity markets that you will not want to miss. Shifting now from macro credit stress to the single most consequential equity story in years, SpaceX has officially gone public and, according to a former Tesla board member who assessed the company's trajectory, has achieved the largest IPO on record. That is not a small claim. Saudi Aramco's 2019 listing held that crown for years, and surpassing it implies extraordinary investor appetite for space infrastructure at a moment when the 10-year Treasury yield sits at 4.49%, actively compressing multiples on capital-intensive ventures. The market is pricing in success before SpaceX has delivered it. The former Tesla board member's commentary is pointed and precise. SpaceX's current valuation is contingent on executing at least 2 of its 3 major strategic moonshots. Those 3 pillars are Starlink profitability, Starship commercial deployment, and long-horizon Mars missions. SpaceX was last privately valued at approximately $180 billion in a 2024 funding round, so the IPO price implies the public market has re-rated the company dramatically higher to surpass the Aramco benchmark. That gap between private and public valuation is not noise. It is a structural bet on the entire space infrastructure narrative, priced in before a single post-IPO earnings report has landed. This IPO is not just about SpaceX in isolation. It is a referendum on the entire venture-to-public megacap playbook. When a private company priced at $180 billion absorbs enough institutional and retail demand to surpass the largest listing ever recorded, it signals that crossover funds, sovereign wealth vehicles, and retail investors are collectively willing to pay a substantial premium for narrative optionality. The problem is that narrative does not service debt. With the 10-year yield at 4.49% and the 5-year at 4.21%, the discount rate applied to long-duration cash flows has risen materially, which means every year of delayed moonshot execution costs more in net present value terms than it would have in a lower-rate environment. The ripple effects land directly on the aerospace and defense sector. ARKX, Raytheon, Lockheed Martin, and Northrop Grumman all face competitive pressure on launch services and satellite communications contracts if SpaceX executes on Starlink profitability and Starship commercialization. These are not hypothetical revenue threats. Launch dominance and low Earth orbit broadband are active contract battlegrounds today. On the growth side, the Nasdaq 100 is at 716.82, essentially flat on the session, reflecting tech's cautious wait-and-see posture. Tesla could see spillover enthusiasm given Elon Musk's cross-portfolio involvement, though the VIX at 19.33 suggests the options market is not yet pricing a volatility event in either direction. The binary catalyst framework here is unusually clean. Watch Starlink subscriber ads as the near-term revenue proof point. They are the fastest path to demonstrated profitability among the 3 moonshots. Starship flight test cadence is the second lever. Each successful orbital test de-risks commercial deployment timelines and directly pressures Lockheed Martin and ARKX on government launch contracts. On the macro side, the 10-year yield at 4.49% is the silent headwind. Any further move higher tightens the valuation ceiling on capital-intensive aerospace businesses. If the VIX breaks above 21, watch for forced selling and high multiple growth names across the Nasdaq 100, which would amplify any SpaceX post-IPO correction. The bottom line is unambiguous. SpaceX has cleared the listing hurdle, but the real underwriting begins now. A former Tesla board member's framing, that 2 of 3 moonshots must land for the valuation to hold, is not a soft opinion. It is a structured risk disclosure in plain language. Defense incumbents like ARKX, Lockheed Martin, and Northrop Grumman are the natural hedge if execution slips. Growth bulls in the Nasdaq 100 need Starlink and Starship to perform. The S&P 500 at 7,396 is holding, and the rate environment at 4.49% on the 10-year leaves no margin for moonshot delays. Those are the 2 stories that matter most today. The full breakdown is now complete. If you want this level of depth every single trading day, specific tickers, real numbers, and the macro context that actually moves markets, hit subscribe right now and turn on the notification bell so you never miss a breakdown. We cover the stories that matter, the levels that count, and the catalysts on deck every morning before the open.